The inflation rate is going haywire. What if we told you there was a way for you to take advantage of this? Welcome to Finan Simple, where money is made easy. And allow us to tell you about a little known US Treasury bond that can make you real money. Before we get to it, let us take a quick look at what's happening so you can better understand the situation. We are currently experiencing the highest inflation rate we have seen in our lifetime. Apart from that, CEOs of major corporations are showing concern over a probable recession. Sound terrifying? That's not all. A recent Bloomberg monthly survey of economists shows that there is a 30% chance of recession over the next 12 months, the highest in 2 years. From the National Association of Manufacturers, about 60% of American manufacturers see a recession coming in the near future. This is already all alarming. But wait, there's more. Neil Kashkari, CEO of the Federal Reserve Bank of Minneapolis, implied that the Fed may need to actually trigger a recession to bring down inflation. To quote Mr. Kashkari, "My colleagues and I are going to do what we need to do to bring the economy back into balance." Let's bring this discussion closer to home. One aspect of the economy that most of you are familiar with is the real estate market. The harsh reality is the housing market is on the verge of disaster. For starters, the recent rate hikes by the Federal Reserve have made the average interest rate on a 30-year fixed-rate mortgage skyrocket. The 30-year fixed-rate mortgage has been steadily increasing at the fastest pace on record. It's currently double what it was at the beginning of the year, sitting above 6%. This is the same level as just before the housing bubble burst back in 2008. Fortunately, variable rate mortgages are virtually extinct and fixed rate mortgages are the standard, which means the double in rate won't affect those who already have a home. Well, at least it won't affect their mortgage payments. But who does suffer? Those who are planning to purchase a new home. From a 3% mortgage rate to over 6% equates to an increase in the monthly mortgage payment of the average home buyer by $800. With a 30-year fixed-rate mortgage, you may possibly be looking at a monthly payment of roughly $2,500. If this were a year ago, you would have only needed to pay $1,700 a month. Pretty crazy. It's crazy to think how a 12-month difference in buying a house can cost you $800 more. That is simply unacceptable for a lot of people. This makes housing the most unaffordable it has been in history. Due to this, home sales are crashing at a rapid pace since the peak of the pandemic. This trend may just continue over to the coming future with the dreams of aspiring home buyers plunging as well. These factors have caused the real estate market to shrink, taking with it the value of your home. As interest rates began to rise, many people entered the market in an attempt to sell their homes. We recorded the largest percentage of sellers ever in the real estate market during the 4-week period ending on June 12. Between rising rates, increased seller activity, and decreased potential buyers, we have seen home values decreasing by as much as 20%. Home values in places like Toledo, Rochester, and Detroit have experienced losses around 13 to 19%. This decline can possibly be chalked up to a necessary market correction as the Fed has been propping up a real estate bubble for the past 10 years using cheap cash to flood the market. CEO of Airbnb addressed the situation, saying, "This moment feels similar to late 2008 when we started Airbnb," in which a lot of people are already agreeing with that statement. But how is the other side of the economy affected? Stocks have gone down for the past few weeks. Almost $3 trillion has been erased from retirement accounts. How about cryptocurrencies? $2 trillion of market capitalization vanished, wiped out. Of course, inflation in the country is steadily increasing, making everything double in price. Is there a light at the end of the tunnel, a star to wish upon? We have found an unknown inflation bond currently offering about a 10% annual return. Wait a minute, what are I-bonds? Maybe this can help you amidst the rampant government cost inflation? To start with, an I-bond or inflation bond is issued by the US Treasury. The amount of interest you earn on the bond is actually tied directly to the annual inflation rate. Sounds like a plan. Well, these have been a thing since 1998, but are not that popular due to it being boring. Usual inflation rates go for about 2 to 3%, and there is usually not a big return in I-bonds. However, during times like this, when the current annualized rate of inflation is at a gigantic 9.62%, that's when the money starts to flow. But of course, there is always a catch to such an amazing silver lining. Firstly, each individual is limited to a maximum purchase of $10,000 per year in I-bonds. It is because it was meant for small savers and investors, not those big-time players. Yet, in every rule, there's always a loophole. For couples, they can get $10,000 individually. You can also gift these I-bands. Simply buy it for each one of your children. Sure, you're only limited to only $10,000, but if you have a family, who knows how many I-bands you can have? Second, you have to hold the I-band for at least a year. If you buy one today, you are simply not allowed to cash it out for the next 12 months. After that time period ends, you can now cash it out at any time. There is another time-based stipulation that is important to mention. If you sell the bond before holding it for 5 years, you will have to give up 3 months worth of interest. If you buy I-bonds today, hold it for 24 months, then sell it then, you will only be able to get 21 months worth of interest. But if you have held the bond for over 5 years, all 60 months of interest are yours. Finally, we mentioned that the interest rate on I-bonds is linear to that of the annualized rate of inflation. The US Treasury adjusts that rate twice every year, May 1st and November 1st. But the purchase rate of your I-bond will remain constant for the following 6 months. Sound confusing? Let us explain it to you through a timeline. You buy an I-bond in June with the current rate of inflation at 9.62%. This is the interest rate you are guaranteed to have on your bond for the next 6 months. After 6 months, the interest compounds on your bond. The I-bond rate is then adjusted to the new inflation rate on November 1st. Let's say it became 10%. Then, for the next 6 months, your I-bond rate will now be 10%. The cycle repeats after 6 months. Your interest compounds again, with the rate resetting again. Once the US Treasury changes it on May 1st, you get the process, right? That is simply what an I-bond is and how it works. You better act fast because it has been steadily becoming more popular. The US Treasury reported that they sold about 10 times more I-bonds this year compared to previous years, which is quite understandable. With an investment that ensures almost a 10% return like this, backed up by the US government, what really can go wrong? If you'd aspire to purchase some I-bonds for yourself, the Treasury itself is the way to go. Simply head on over to their website, www.treasurydirect.gov, and set up an account there. Take advantage of the rampant inflation today. Always stay focused on learning and developing discipline. Get educated, make a plan, and stay the course. If you found this informative, smash the like button, please share it with a friend, comment down below, and let us know what would you like to have made finance simple next. And definitely subscribe so you don't miss new content. Keep your head up, ears open, and always search for knowledge. See you soon!